Good morning once again. I'm back. Andrew Work here at the Conversations with Global Investors, a conversation with you and our panelists that we are about to bring on stage for the next phase of our event today on day 3 of the Global Financial Leaders Investment Summit. We are really excited to have another panel. We are talking about managing through volatility. These are definitely volatile times in the markets. Fortunately, we've got a great panel that's going to help us move through these volatile times. Our moderator for this panel today is a hometown hero. He is the Deputy Chief Executive Officer of the Hong Kong Monetary Authority. He is responsible for reserves management, financial infrastructure, and the exciting world of fintech. Please welcome our hometown hero, Mr. Howard Lee. Hey. Thank you.
Thank you.
All right, Mr. Lee has a great panel lined up for you. First, we welcome Mr. Stephen Klar. Mr. Stephen Klar is the president and managing partner at Wellington Management. Thank you for joining us today. On stage yesterday and back again, we welcome Hanneke Smits, who is the CEO at BNY Mellon Investment Management. And next, we would like to welcome Cyrus Taraporevala. Cyrus is the president and CEO at State Street Global Advisors. Thank you very much for joining us. Howard Lee, take it away.
Okay, thank you very much, Andrew. And thank you all for coming. I think most of you have sort of listened to the previous panel moderated by Shank, which set a very high benchmark for all of us. And to the moderator, I'm under tremendous pressure because Shank was like a spreadsheet of data. He can recite the economic figure of any year you pick. But the good thing is he set the scene very well, and I don't need to labor on a lot of the background. And you also sort of listened to the panel discussion, Greg chats yesterday. So they provide a very good scene for our discussion in the next hour or so. What I would like to sort of add is maybe a little bit of reality check as well. Talk a lot about uncertainty, about risk, and just this morning we heard the announcement of the Fed to hike rate another 75 basis point, and there's a signal that don't expect the terminal value to be around 4.6 as previously expected. It could go higher, it could go longer, so pressure is really on. But even before that, as an investor, we look at the performance of our investment in the last 9-10 months. Public equities market generally down by anything between 20 to 30%, especially if you take into account exchange rate regulation. Even bond market, 15-20% loss of value, pretty common. So we are actually licking our wound. Just now we heard that everybody seems to have unlimited capital to deploy, but a lot of us really thinking about how we account for the year. And I think later this month, Eddie and I go to Letchco to report our Q3 result. I'm still struggling how to piece together a story for that. It's not going to be pretty anyway. I would just like to put this in this perspective and then see how our managers help their clients manage their assets and how do they see the flows in this kind of environment. Now, I would perhaps start with Cyrus. I think a lot of the audience in the audience know that SSGA is a huge asset manager. One signature product is their ETF product on different markets, different products. Now, this is a pretty good proxy in the sense that under this kind of a very difficult market condition, a lot of investors would need to liquidate, would need to rebalance. So what kind of flows do you see among different products, different segments, and then even different geography of investment? How do we take a glimpse as to the kind of reaction of investors in this, and what kind of lessons we should learn over this, and what are their positioning going forward? So can you share some insight with the flow of data that you can see?
Sure. Thank you, Howard. And let me actually focus on the US ETF industry. It is a subset, but it's the largest part of the global ETF industry. Though I do think most of the trends are fairly similar across much of the world is what we're seeing in the US. And I'm intentionally going to focus on the ETF industry and not talk my own book. I find it gets me into less trouble with my compliance crowd. Let me pull all the way back. Combined US ETFs plus mutual funds. You put those together and you have $270 billion of outflows. $270 billion of outflows year to date. This is September year to date. You double click on that and you say, well, that's kind of interesting that you're in outflows because US ETFs are on track to have one of their best years ever. Comfortably above 500 billion is the current assumption for a full year, could cross 600 billion as well. And as you said, Howard, we look at the ETF flows because we think it's a very good indicator of how investors are actually deploying capital, but also the sentiment. Because for a lot of investors, ETFs remain the most cost-efficient, transparent, and rapid way to put money to work. So what have we seen this year to date? First thing I'd say is money's been invested in flows across the major asset classes. So across the major food groups, both equities and fixed income, you've seen positive inflows. And let me just unpack each of those and maybe sort of pick on three areas. The first is fixed income. So over 100 billion this year of ultra-short duration government bond ETFs, and that's a record. Ultra-short duration. In the equity space, you could look at it multiple different ways, but I'll start with the observation we've seen over 50 billion going into equity dividend ETFs, and really we think of dividend as an interesting indicator of both value and quality. If you say, no, I want to be more simplistic about value versus growth, we would say the vast bulk has gone into value, not growth. If you're one of those sector kind of folks, the major inflows have been into healthcare, consumer staples, and utilities year to date. Again, the more defensive sectors, if you will. Pretty strong outflows from financials, consumer discretionary. And then more recently, we've seen some interesting positive inflows into energy and even technology. Let's pick on commodities. I do think it's interesting. Gold has seen about $3 billion of outflows. So that's interesting because typically and traditionally, when you're worried about inflation, you go into gold. And no, before you ask, Howard, I do not believe that all investors are going into cryptocurrencies as a surrogate for gold, so that's not our current thesis. And then what you've seen in October is very interesting. You've seen a complete reversal. You've seen $90 billion, $90 billion, flow into ETFs in more of a risk-on mode. So if you think about the first 3 quarters, it's been more risk-off. October's been big risk-on, $90 billion. Let me put that all back into the broader sort of investor context of how are investors feeling about it, which was the other part of your question. I'd say very simply, there's 2 types of investors that we see. There's the first type, which is they're going to stick with their strategic asset allocation. Many of our largest, most sophisticated institutional investors would fall into that category. And they're basically rebalancing, and there's a lot to do in terms of rebalancing, even without discussing the denominator effect, which I think the prior panel did very nicely. So you see that crowd sort of steady as she goes, keep calm and carry on. And then you've got the more tactical investors, and they are definitely in much more of a risk-off mode. Not surprisingly, we also run some strategies ourselves in a more tactical fashion. In our own tactical portfolios, we're 12 to 13% cash, And keep in mind, the strategic asset allocation to cash strategic weight is 0. So being 12 to 13 in cash versus 0 is quite a big statement. We are interestingly underweight fixed income. That's our biggest underweight, and it's barbelled. We have very short term, and then we actually like longer duration sovereigns. Think 10-year US Treasuries, for example. Fairly neutral on credit, underweight high yield. And again, this is all publicly traded, not private credit, as the prior panel talked about. You know, we are of the belief, and I think a lot of investors are of the belief, that the Fed will do whatever it takes to tame inflation, whatever it takes. So I think I slightly disagree with some of the prior panel on that. And the real question now for most folks is, well, what will it take? And is the cure for inflation going to be worse than the disease of inflation? And will it therefore tip economies into recessions? And very importantly, what does that do to corporate earnings? And that's the shoe that hasn't yet dropped. So we remain underweight equities. You could look at it, and at one lens, you could say valuations are looking more interesting, but we're not quite sure the E is yet sort of reset to where it needs to be. More broadly, I would just say the outlook for investors is very cloudy. We don't see people racing back into risk-on mode, though again, I will say we were caught by surprise with the October flows we've seen. I think before we see investors flowing back into the markets in a seriously big way, you'd have to see two things happen. Number one, you'd need to see the Fed, as well as other central banks, start to signal that they're getting closer to the end of their tightening. So you're going to see a yield curve that goes from inverted to flatten, maybe even starting to see it steepen before investors take that as a good sign. And the second is you're going to have earnings get a lot clearer than they are today. And we believe until those two signals arise, we'd be surprised if investors broadly got back into risk-on mode.
I see. Very good. Now, perhaps next I turn to Steve. In the previous panel, we heard quite a bit of a discussion, private, public, and that kind of a debate. I wonder whether Luke would rather stay in this panel than the previous one. But Wellington actually manage a diverse range of products, fixed income, equities, alternative, multi-asset. Now, with this environment, equities has seen a lot of correction, but still whether it's a good time to catch a falling knife is really a big question. Maybe everybody is waiting for the two signals that Cyrus just talked about, but still we need to deploy money. And obviously, alternative and private market has been gaining momentum in recent years, even not just traditionally the institutional investors, but the high net worth individual and even private banks are selling a lot of private investment products. So you overlooking this range of products. So what's your take of it? Do you see this trend in your perspective? And also in this kind of switch for different types of investors, what are the issues that they need to be aware of? Is it really a one-way street that will provide private equities, private investment will provide the stability and also superior return over time? The only thing you are foregoing is liquidity. Is it a good narrative of this?
Great. Thanks, Howard. And I want to thank Eddie and HKMA and the Academy of Finance for having the vision to host this event. And as I was saying to Eddie earlier, being in our offices, being with our colleagues who have served our clients so distinctively through a very difficult environment has been very important, and it came through the inspiration of this conference, so thank you. You know, as I think to it doesn't happen often that equities go down 20+% and bonds go down 15+% in the same year. It's usually there's some some diversification across those two. And I think what we've heard over the last few days that we would echo is this marks a change. There is a regime change of sorts in the macro world, in the markets, that we all and our clients and investors need to take hold of. And as we reflect on that, I'll only talk my book for 1 minute, unlike Cyrus, which is to say, when we think about the 10 plus years that we've experienced of markets generally going up, of clients logically leaning into that and therefore investing in much growthier investments, in more yielding investments, that the time has come to revisit the asset allocation that will serve us well for the next 5 to 10 years, knowing that, as the previous panel said, none of us are going to predict exactly how it's going to unfold. But I think there's enough uncertainty that we have to respect a sufficient range of probability distributions to have an asset allocation that's going to be a little less all in on growth and the highest yielding opportunities out there. And so as we reflect on that and as we work with our clients and think about higher inflation, probably more volatility in inflation and in markets, we're working with our clients on thinking through how to really get that asset allocation back to a more diversified and rebalanced, as Cyrus said, manner to really be able to navigate, knowing none of us are going to get the environment perfect. So a couple of themes I'd highlight. One is a greater allocation, and Luke will like this, greater allocation to absolute return market neutral strategies, leveraging global macro, leveraging long-short equity. But the idea that you want some portion of your portfolio to not be reliant on the beta of markets seems very, very logical and appealing. And we're seeing clients engage with us and move in that direction, again, to some extent of the portfolio. As growth has grown so much over the last 10 years and value has been such a painful trade, inevitably many clients find themselves overweight growth, even taking account of this year's market return. So we're seeing more of our clients engage with us on getting that balance right between growth and value, and typically increasing their allocation to value strategies, in some cases to value sectors like healthcare, and in some cases to countries that have a lot of value securities like Japan. So definitely value as a theme and getting that balance right between value and growth. And then, you ask about privates, and we do see the value of privates. And in fact, there is a blurring going on between publics and privates. So just, one example, if you take the first 20 years of the 2000s in the US, private equity-backed companies went from 2,000 to 8,000, and public companies went from a little over 7,000 to a little under 4,000. Mm-hmm. So if you look at the opportunity set, there's a blurring going on. Companies are staying private longer. So we do believe taking advantage of that blurring, having investments on both sides of the ledger, public and private, and in fact, in our case and with our clients, taking advantage of that late stage pre-IPO private equity arena is one that we think remains very attractive. And in fact, we're seeing greater interest in what I would refer to as hybrid strategies, strategies that are going to allow you to pivot. And I think, you asked privates, publics. I think it really is company dependent. There are some companies in the private range where maybe you can go out and invest at attractive prices now, some that may still carry a valuation that feels rich, similar on the public side. But being able to arm the portfolio teams to be able to decide which privates to invest in, which publics, when to have a slightly bigger lean in one direction or another, we think will be attractive as we look ahead. Fourth, I would say, is real assets inflation hedging. It's been a painful trade for the prior years before 20. We've seen those allocations go down over the last decade, and now we're seeing them come back, and I think it's an appropriate part of an overall portfolio. And then lastly, yields have risen so quickly that there are some interesting pockets of risk return in the fixed income markets, depending on the client. So if you're a pension plan that's trying to match your liabilities, 6% return in IG credit could be appropriate for a portion of your portfolio. If you're more return seeking and risk seeking, there are some attractive securitized sectors. If you look at some of the European credits, there are some very high yields, as we heard earlier, high single digits, low double digits. And if you can pick those securities right and stay away from the ones that are going to default and go away, that's a very attractive return. So those are all areas we're working on with our clients as they reposition their portfolios for this different regime looking ahead.
Well, you bring up a couple of very important points in the sense that first, this is a paradigm shift, a change in regime in terms of financial market. Second is you can rely a lot less on beta, and you need to have someone who can generate absolute return. And also private market is more important. That all points to the difficulty or the importance of selecting the right manager for this, instead of the kind of Ryan beta, every CIO is a genius in the kind of up market. So what you would advise on investor in terms of this kind of environment, because the regime change also means that really just like what our product fact statement suggests, past performance doesn't equate the future performance. So it's a regime change. What should an investor do to really find the right manager for them?
Yeah, so there's heavy competition amongst asset managers. So I think that's the good news, is that there is a lot of choice, a lot of due diligence that could be done to select who is the right manager for different areas. And I would say, just to echo your point, if you stop the clock at December of 21, the return of equity markets was at historic levels measured over the prior 100 years in terms of the 3, 5, and 10-year return. So again, none of us know. That could continue for the future. But if there's any sort of a return to long-term averages, the amount of return from the betas could be less than we've experienced in the last 10, 15 years. And therefore, in order to achieve the returns that we know are needed for the end beneficiaries, whether they be retirees, whether they be scholarships for colleges, whether it be research, is going to need more alpha. And so selecting that alpha is really important. And the way we do it, because we're privileged, we have over 50 investment boutiques at our firm. We spend a lot of time holding them to a high bar to make sure that we have confidence they could deliver for our clients. We spend a lot of time looking at the data, but as you say, looking at the data in the context of a philosophy and a process. What is the market inefficiency you're taking advantage of? What is your edge? Is it a sourcing edge? Is it a security selection edge? Is it a research edge? And how could I see that in the numbers? And if you can see it in the numbers and you understand it and you can cross-check it and they're exercising their responsibility consistent with their philosophy and process, that gives us that higher confidence that they're likely to perform in the future, either like in the past or even better than the past.
Okay, thank you. Now, that brings me to Hanneke, because we talk about the challenges of not just investors, but managers. And I would add to that is with the market drawdown, with less money in the system as the central banks do kind of different pacing of the QE, the AUM of a lot of managers are actually coming down. That's a big issue to managers. So in this kind of environment, how do you think would a manager cope with it? And what should be the business strategy to cope with this situation? And some investor might even say that if I just buy US Treasury and I got 4%, 4 something percent without leverage, so why bother? Should I pay fee for you? And I may as well park my money until I see the signals that Cyrus talked about. So how should we, I mean, you in terms of a manager, deal with this kind of situation? Is it a challenge to you, or you see other opportunities?
So the good news is I do get to talk my own book. Is that what you're suggesting with your question? No, but joking aside, thank you for inviting me onto this panel, and actually thank you for having me again, I should say, at the conference. Look, uncertainty actually always creates opportunities, right? We do have the backdrop, to your point, that we've seen of a decline in AUM, both in the equity markets as well as in the fixed income markets. So when you run an asset management firm, as all of us here on the panel do, you just sit there and watch, and you see the value of your AUM go down. In our case, it's equity markets, fixed income markets, and it's also currency. About 50% of our revenues is ex-US, so over 50% dollar-based and 50% non-dollar. And in this environment with strengthening dollar, that clearly in the short term has an impact. So I sort of want to separate here between what it means for managing portfolios versus managing the business. From a business perspective, I think there are some big trends that sort of have been around for quite some time, right? And there's sort of around 3 areas. One is clients look increasingly for strong differentiation from active managers. So they're moving away from, managers that propose to be benchmark, to have more specialty active, and that can take different forms, that can take the forms.
I'm not sure Cyrus agree with you. Maybe I tend to.
No. I'm going to go to the other side as well. I'm going to land on passive too. So it's a so-called barbell approach. So you can't. It's hard to sort of sit in the middle of traditional active and traditional income. It's either more specialist, or actually find solutions that you can deliver in a more cost-effective manner, and that's where clients look for more passive products, buying indices or indeed ETF solutions. We're seeing the trends of the demutualization. Clients, and Cyrus just spoke about that very eloquently, clients are getting out of mutual funds and more into ETFs, both passive as well as increasingly active, because they're more cost efficient and they're more tax efficient. So on one level, back to what they're looking for returns. The current markets, which they always of course do, but in the current markets environment, what they're looking for is more outcome-oriented investing. So the absolute return strategies that Steve was just talking about, or they might be looking for inflation protection. They might be looking to manage their portfolios in a more tax-efficient manner. But at the same time, the underlying theme has also been that clients have been looking to reduce the cost. And they've also been looking to do business with fewer firms, which is why it's so important that for firms our size on this panel, that you actually can offer a wide range of capabilities onto your platform. So we sort of tend to think about it that clients can come shopping in our organization, and we offer different strategies, and we also have boutiques on our platform, and there are different solutions depending on what the clients need. So I think you need both investment expertise, and you need to be able to deliver that at scale in a cost-efficient manner. So investing in products, in your technology, in the wrappers is important. And then I would say the third piece underlying all of this has been the client experience in itself, that I know we've been investing in, and I suspect my co-panelists have been investing in as well. And this has been somewhat turbocharged by COVID, where we've all had to engage with clients virtually. I took on this role in October 2020, and as I thought about meeting clients,
that was an opportunity.
That was actually it turned into an opportunity. And of course, in the pre-COVID days, one would think, okay, I'm going to get on a plane, not very carbon friendly, but I'm going to have to go and see colleagues and clients around the world. And I did all those visits virtually. And now that I look back on it, I'm actually convinced I've seen more clients in a shorter amount of time than I actually would have achieved if I'd gone around the world to meet them in person. So having said that, coming out of this, what we're seeing is that clients want to engage differently. They do want that in-person contact, so it's actually great to be here. It's great to visit different regions of the world, but they want to see us in person less frequently, and they want to engage more digitally, so they need better analytics around reporting. You need to invest in a better digital experience. We're investing in a more appy experience where clients can get through an app content on their phone in a very timely fashion, in a very short fashion as well, with the appropriate analytics that are also going to provide tools around portfolio construction, asset visualization. So all of this means, you need to invest, and clearly that can be challenging in an environment where your AUM is down, but that's also where I would come back to say it's really important to have scale, which actually all of us on this panel do. So a number of trends that I think have been prevalent for quite some time about more active capabilities, delivering capabilities in a cost-efficient manner through new product technology, and actually investing in the client experience. From our perspective, are trends that are here to stay, and certainly we're trying to solve for.
Right.
Howard, this may surprise you, but I completely agree with what Hanneke said about alpha is going to be more important than ever. And yes, we're one of the largest beta providers in the world, but we also have alpha teams. Now, here's the problem with that. A lot of folks who claim they're delivering alpha, when you actually disaggregate their returns, you can explain away 80+% of their returns as being some form of a factor, which I would argue is not an edge, because you can get that a lot more effectively by buying that given factor if you want value as a factor. So I do think the true idiosyncratic alpha generators will be in greater demand than ever. But they're not as many as there are active managers who purport to be alpha generators.
Yeah, absolutely. And whether the alpha generated over time really commensurate with the fee that they are demanding, this is something that we always look at. And it's, there's not a lot of managers who can consistently deliver that over time and through the cycle. I think this is a challenge that institutional investor faces. And with this kind of drawdown, in this kind of environment, I suppose a lot of investors would, because of the shrinkage of their own balance sheet, they become a lot more ruthless in cutting managers, switching managers. And I don't know whether this is something that would make you see the industry more competitive and so more difficult environment for everyone. And also, do you see a pressure on fee on this? Or because more people switching to active, probably that's a fee positive. But with this kind of environment, is it something that you worry you about the kind of pressure on fee as well? Anyone want to take this?
Well, I've been on many panels over the past 3 decades, and there's always been a topic on, is there pressure on fees? And I don't think that will really go away. So it really comes down to sort of the value for money concept, right? What is it that you're delivering for your clients? So if it's a true active strategy, are you delivering to the target, whether that's a benchmark-based target, whether it's an outcome-based target? And therefore are the fees appropriate? Equally, because of the pressure on fees, we've clearly seen the trend of clients switching out of traditional active into passive, and actually that's been relatively easy for them to do so and relatively rewarding from a performance perspective over the last 10 years. I think the current environment is actually a really good environment for active investment managers to prove their worth. Uncertainty creates challenges, but also really creates opportunities for the brave. The price discovery that was so much discussed at the previous panel, I have to say I agree with Luke, who mentioned very appropriately that price discovery is also a big feature of the public markets, and that is going to be even more important in the environment going forward. And there will be opportunities, and we see it in our own portfolios where we can find stocks that are outperforming the indices and delivering returns to clients, but you're going to have to look hard. And I suppose for the clients, to Steve's earlier point, they will need to continue to evaluate the managers. It is fiercely competitive, and then judge whether they are delivering to the stated mandates.
Okay. Thank you very much. Now, let's move on to a slightly different topic, which is something that we heard a lot about in yesterday's panel from Mark Carney, also Hanneke as well, is ESG. Now, we all agree that ESG is a very important issue, and there's increasing awareness and importance attached to ESG. But from what you see, is this more talk about it, or you see from investor behavior, you're really seeing more money flow going into it? And what kind of products or what kind of theme that you see would best appeal to investors, and how do you position your firm to capture this mega trend? So maybe I'll start with Cyrus.
Sure. I think it's very different in different parts of the world. So Europe, I'm sure Hanneke will attest to, given that she lives in London, is very much still in sort of ESG demand is very high. I do think the US is becoming more politicized. And part of that, by the way, is I think there's a basic misunderstanding or confusion on what ESG means. And it does mean different things to different folks, so it's not unexpected that there's a confusion. I describe it as one of two different flavors, and unfortunately, the popular media, now aided and abetted by politics, sort of conflates the whole thing and mixes it all up into one big jumble. So you can think about ESG as an input, as you're looking along with the rich mosaic of more traditional financial metrics, how a company's strategy evolves, et cetera. You can think about ESG as another set of inputs, but you're using all of that in that rich mosaic to come out with the best portfolio that's going to give you the best risk-adjusted returns from your portfolio. So that's one definition. The other definition is, no, I want a positive ESG score portfolio, and therefore the objective function is now get me a positively scored ESG portfolio. And by the way, since nobody can agree on the scoring, you can do whatever you like with that. I was with a client some years ago who told me that in a year, he had reduced the carbon intensity of his overall portfolio by over 25% in 1 year. Is one of the largest sophisticated institutional investors in the world, and I couldn't imagine how he would have shifted his entire portfolio. This would have been tens of billions of dollars of shifts. So I said, wow, that's really interesting. How did you do that? How did you not sort of impact markets? And I kept trying to wrap my head around this, and he said, Cyrus, I just changed data providers. So, there's a lot of greenwashing that goes on, and I think we just have to be very, very careful about that. For us, we come at this as, for us, ESG is about value, not values. And that's been our compass on this topic. Now, don't get me wrong, if a client wants to express his or her values, that's fine, because it's the client's money, it's not my money. I'm investing on behalf of clients. So if a client wants to remove, pick your favorite thing, tobacco, guns, what have you, from their portfolios, that's fine. But if we are making the decision, it has to be about value, not values.
I might just build on that. Very similar philosophy at our firm as Cyrus outlined. What I would say is the secular interest, demand, commitment to ESG is strong and growing. And it's becoming more nuanced, and I think there's a recognition that it's very complicated, and it needs all of our efforts and brains to actually really keep studying it and making good judgments. And it's not as simple as, we're going to define this company this way and that company this way by, these 3 scores. And so that is giving me a lot of optimism that, yes, the trend is real, but it's becoming more nuanced. So I just want to tell a story. I was in Europe several weeks ago, and a client proactively asked me about nuclear energy that previously that client had just said nuclear energy shouldn't have been something that would be invested in. And they asked how to think about defense companies, given that the NATO countries are going to invest 2% in the defense. So those to me were good examples of, yeah, it's a complicated question. It's not one anyone could just answer just like that. And we have work to do to incorporate all of these factors, as Cyrus said, to reach good decisions. And we too have applied a value approach, a non-concessionary. ESG factors are part of making good investments and generating returns for clients. And we think that the ESG factors are more and more influencing the prices of securities and need to be factored in order to do an excellent job for the client. So how we're dealing with it, we're kind of focused in 3 areas. Number 1, our edge is research and engagement. So we are spending time with every company, around the world where we have any of our clients' capital, and including some where we're considering whether to put our clients' capital at risk, and really spending time working with them on obviously climate issues, like what are your science-based targets to understand your carbon profile. But we understand there's a lot to be figured out. It might not all be buttoned up today, but it needs to be headed in the right direction. But it also involves other things, like if you take healthcare companies, understanding product safety and quality issues. If you take payments companies, cybersecurity risks. So looking at all of these risks that could impact different companies in different ways. We have a dedicated ESG research team that works alongside our equity analysts, our credit analysts. We tend to meet companies with those 3 analysts all together, really taking that full mosaic in to really understand and come up with good decisions in our portfolios. The second is there's a lot to learn, so we're doing a lot of primary research. We have engaged in 2 scientific research relationships, one with the Woodwell Institute around physical climate risk, mapping the risks around the world, drought, fire, heat, flood, and understanding the implications of those on capital markets, on the companies or municipalities that we invest in. And we have more recently entered into a research relationship with MIT's joint program on the science and policy of global change. And that research is going to be focused on transition risk. And how do we get to a more climate-friendly set of energy policies and principles? We probably can't just do it by flipping a switch. We actually need to think through each of the energy sources, think through the path to get to where we're going, and we're very excited about that research to allow us to engage with companies on how they can get to, what Mark Carney was describing, get to this path that we're heading. And then the last thing is, as Cyrus alluded, there are investment opportunities. If the world is committed to addressing climate change, there are going to be some growth businesses out there in helping the world get there. There are lots of companies that are really focused on helping the world get to a better place on climate, on other social issues. You think about food insecurity, water insecurity. And so for clients that want that, we have portfolios that are very focused on taking advantage of the growth opportunities of the impact that we're trying to create both in equities and bonds, but with a goal of achieving a return, not just achieving the long-term impact.
But I suppose this is still very much a life issue in terms of data, taxonomy, and even clients' understanding and his value and values of ESG and client engagement, I suppose, is very much important in addition to your engagement with companies, right? Okay, so with that, Hanneke, anything to add?
Yeah, no, I think you just made a very relevant observation. We spend a lot of time at the moment actually educating clients, clearly in terms of interest. A lot of it started with our European client base. From our perspective, most of our managers have actually their origins in Europe, so we feel very confident we actually have in-house strong ESG credentials, and I agree with Cyrus. This is really, we think about ESG as an input into the process and helping us determine the value of the underlying securities. But then once we go to the US, where the environment has become so politicized, I find when I speak to clients in the US, very quickly you get into a lot of potentially confusing conversations. Are you talking about ESG? Did you really mean sustainable or social impact? Are you boycotting energy companies? No, but so there's a lot of time spent on the educational piece. And then finally also working with regulators, right? It's really important, and regulators around the world, including here, have issued guidelines, and I think it's really critical because we need the end client to have confidence in the taxonomy, right? In the labeling of funds, in the taxonomy and vocabulary of ESG, because otherwise they actually won't be investing in it. And I think there's some really good work that has already been done in terms of clarifying that, and I know we're actively engaged. I'm sure my colleagues here on the stage are actively engaged with the regulators as well to land that in a good place. And we've also been very pleased with the global coordination on the part of regulators. So for us, ESG is very similar to what Steve described, very much integrated into the research process. It is way more than the E, although that does capture a lot of the headlines. I spoke about this at the panel yesterday, that some of our research is showing that about $100 trillion is needed in capital, which will create, I think, very exciting investment opportunities to get the world to meet the goals that were set out in Paris of achieving net zero by 2050. But that, if we get there and we take advantage of these opportunities, I think there's sort of two wonderful outcomes. Not only will you get a massive payoff to society, right, to achieve these goals, but I also think it will really offer the opportunities for some very interesting financial returns. And being here in Hong Kong, I have to say it's somewhat reminiscent of the opportunity that China represented in the early 90s, and listening to Bill Conway talk about the 350 billion in GNP that has become to 17 trillion. I don't know what the $100 trillion would equate to, but I do think it could be a transformational opportunity for the investment community. And that to me is exciting.
Yeah. Thank you very much. Now, we are a few minutes away from the appointed time for this panel. Perhaps I now open up to the floor to see whether anyone has any question for the panelists. We have microphone in standby. Yes, this gentleman over there.
Thank you for the fascinating insights this morning. My question is on ESG. Do you take a different approach to investing and ESG in Asia than in Europe? Because the challenges in Asia, especially on energy transition and a just transition, are very different from those that are faced in Europe.
I'll take a shot at it. Again, I think if you start with thinking about it as value and not values as your compass, then it will be different. It may be different in multiple parts of the world. But we actually start with the belief that we will need fossil fuels for the foreseeable future globally. So I don't think your question, which sort of embedded says that's not true for the developed world, but maybe true in the developing world, I would quibble with it. We believe we will need fossil fuels for the foreseeable future, and we believe that the large energy companies will need to be part of that transition over the next coming decades. They have the capital, they have the skills, they have the talent, they have the know-how, so they have to be part of this. And I do think that's some of the unintended consequences, and Hanneke, some of your points just sort of triggered this thought for me, that there are things that are happening in parts of the world that actually trouble us in the way people are going about the climate transition. And I'll pick on three. There's probably a longer list, but I'll try to be succinct. The first is decarbonizing a portfolio is not the same as decarbonizing the world. So we fundamentally believe in engagement, not divestment, because you can decarbonize a portfolio really simply, but I'm not sure the world's a better place for it, candidly. The second thing, and Steve talked about this in his client that he met, in Europe in their conversations about nuclear. We do think the taxonomy is dangerous. We think this green versus brown should probably stay with kindergarten. I think it's a more nuanced conversation. We actually think, we like to think about it as a spectrum from dark brown, think thermal coal, all the way to dark green, probably think wind. But the actual movement, I would argue there's more value in moving the world from dark brown to lighter brown. And depending on your taxonomy, nuclear might still be in the lighter brown, certainly gas would be there. So we think there's actually more value there than trying to move from light green to dark green. But the world somehow, there's a part of the world and investors who aren't actually seeing that nuance. The third unintended consequence I'd highlight is, you've all heard about greenwashing. We're actually more worried about something in the public markets that I term brown spinning. What's brown spinning? Brown spinning is basically where publicly traded companies, under pressure from a certain segment of their investor base or the broader society, sell off their highest emitting assets. They just don't want to deal with it in the public forum. Typically, they sell it to private owners and other players at a discount. That's the worst of all possible worlds. You've reduced disclosure, you've put it in the hands of potentially an owner who cares even less about it than in the public world, and you probably have destroyed shareholder value because you sold it at a discount. So that's the sort of unintended consequences that we worry about, and I would say these are global. It's not just a developed market relative to Asia sort of unintended consequences.
Yeah, I think that's a very good point. I see one more hand at the back.
We have all seen China equity markets has been recovering over the past 2 days. We'd like to hear your view, independent and objective view about China equity market. Do you think it's cheap enough, or you want to see more? You see more downturn before it goes up? And if it's the later case, what are the key catalysts for you to see before you see the market to go up? Thanks.
Steve?
Sure. So, there within the walls of Wellington, there are going to be many opinions about China equity markets or any equity market. But I would say, those of our teams that are very focused on China are definitely paying close attention at these levels. There are some interesting buy opportunities, and always done in the context of evaluating the backdrop. To the extent confidence grows around reopening, then there are going to be some companies that are going to have some big opportunities to grow revenue. So I think that's one thing. What we always talk about, geopolitical tensions, that's probably going to be one that has to be factored in and will ebb and flow over time. But in general, continue to have the view that there are a number of exciting companies in China that are broadening out the middle class, that are deepening the consumer sectors, that are deepening the healthcare sectors, and technology. There are just a lot of exciting opportunities. Any one company at any time might be more interesting than another. But in general, right now at these levels, I would say we're attracting interest and picking securities as best we can.
Okay. Now, thank you very much. And I think this brings us to almost the end of our panel. But before I close, because this is the final panel of these 3 days events, our caption or title of this panel is Managing Through Volatile Markets. And we heard a lot of discussion about the uncertainty, the risk. And at the end of the day, all of you are asset managers. A lot of those sitting here are your client or potential client, or they are more perhaps watching this panel through the television broadcast. So perhaps I give each of you 1 minute to sort of pitch to your client or give advice to your client as to, after all these discussions, these chats, how you would advise them on managing their assets going forward. Who would like to go first? Hanneke, ladies first.
Well, literally giving advice, I don't think will go over very well with my compliance team. So I'm going to take it slightly differently, if I may. I think uncertainty is actually a very exciting time for active managers. Someone much wiser and experienced than me said to me decades ago, that's what's really important in investing is obviously to pick well, but be different, right? So you want to be if you look at a quadrant of consensus and non-consensus investing, and you think about the efficiency of markets, being right or wrong, you want to be non-consensus and right, and that's really how you generate returns for your clients. So as a firm that has most of our capabilities in the active space, this is really a great opportunity for our portfolio managers and research analysts to try and pick those securities and be, non-consensus and generate great financial returns. So that's actually where I'm very excited.
Okay, thank you. Very good. Cyrus.
I'm going to take a different angle on this rather than talk my own book, which is simply, I would say to investors, given the paradigm shifts, which I won't repeat all the reasons why there's a paradigm shift, really, it's a great time to re-underwrite your strategic asset allocation. Are you actually allocated in line with your risk-return profile? For a lot of folks, the last 10 years has just been a one-way trade, and I think people have sort of lost sight of the compass of what is your risk-return profile, and make sure that your asset allocation is in line with that, and then, frankly, keep calm and carry on.
Very good advice. Steve, you have the last words.
Yeah, I would just say the partnership between investment managers, the investment office of all of the clients out there, and the end beneficiaries has never been more important. And as Hanneke has said, the opportunities, this is when we should shine, all of us together, is when we make good decisions on behalf of the end beneficiaries through times that are uncertain, are emotional. This is our chance to come in, make the best decisions we can, and in aggregate, if we make more good decisions than bad, because we won't get them all perfect, we will add value to the end beneficiaries and help them get to a great place. So I approach the uncertain times with energy and enthusiasm, even though it's hard.
Okay, thank you very much. I see many people taking notes. I'm sure some of them will come up to you later and for more detailed discussions. But with that, that brings us to the end of this panel and actually this summit. And so let's give a big hand to the panelists.
And of course, a thank you to our moderator as well, Howard Lee. Great job.
Thank you.
Deputy Chief Executive of the HKMA. Well done, sir. And if I can have the four of you forward, front and center for a photo, of course. I mean, volatility cannot be avoided, but at least now they've presented a little bit of a brighter picture on how, a little bit of a beacon in the stormy seas. So thank you very much to our panelists led by Howard Lee. All right, there we go. Big smiles all around. Excellent, excellent. Auditioning for your modeling careers.